at it?
Yes.
So I got a question over here from Willie about freelancing and whether it's better to be a sole proprietor or incorporated. So maybe I'll answer that while we're waiting to kick off here. So typically it's better to be incorporated, but everyone's situation is different. The reason it's more beneficial to be incorporated is for a number of reasons. Starting with a non-financial, it opens up the market. There's usually a lot more opportunities available for incorporated entities than there are for sole proprietors. A lot of end clients just will not deal with sole proprietors because there's some increased risk for the end client, for the agency, and also for the independent contractor themselves. In addition to there being more opportunities available for incorporated entities, there's also some limited liability protection. So when you're incorporated, you have a separate legal entity, and the assets of that entity are what are at risk from any litigation. Whereas if you're working as a sole proprietor, all the assets that you own personally would be potentially at risk if there was ever some litigation. There are some other ways to protect that with great insurance. And I know that maybe, who knows, we might even get some people from LMS who might join in and talk about that today. But also there's financial benefits, and the financial benefits come from the ability of a corporation to leave money inside of that entity and have it taxed at the small business tax rate, which is only 15.5% here in Ontario. And on the personal side, your income is subject to the marginal tax system, which means as your income goes up, so too does your tax rate. And the tax rate personally can go as high as 46%. So obviously a significant advantage to be able to leave money inside a corporation and have it taxed at 15.5% rather than the 46% that you could be potentially taxed personally. So some big financial advantages. And in addition to the small business tax rate, there's also a few small differences in what you can deduct as an incorporated entity versus a sole proprietor. And that really comes down to home office and automobile expense. And in order to deduct your home office when you're a sole proprietor, it has to be your primary place of business, and you have to be meeting clients there. Now, meeting clients can be virtually like we're doing today or over the phone, but it has to be a primary place of business. Whereas when you're incorporated, it only has to be available for you to use, which is a subtle difference, but an important difference, because that can be a substantial deduction for the average independent contractor. Plus, there's also some differences with your automobile expense, because a little known fact about your automobile expense is that you cannot claim the mileage driving from your home to your end client. Now, you can claim the mileage driving from your home office to your end client, but if you're not able to claim your home office, you're also immediately going to lose a lot of deductions really quickly. So that's important to keep in mind. Can you also comment on incorporation, unincorporated partnership, and sole proprietorship? So we talked a little bit about sole proprietorship. There is one other form of organization that's available here in Canada, which is partnerships. And partnerships are pretty much, well, I discourage partnerships at all times, because when you have a partnership, it basically acts as a sole proprietorship with one big negativity, and that is that your partner can legally bind you to a contract or a commitment, and that's not something that you would ever want to be on the hook for. So typically we would recommend that if you're looking at partnering with someone, that you set up an incorporated entity and use a shareholders agreement to make sure that it's structured properly. Great question from Poncho Joe here about whether you should incorporate federally or provincially. And we almost always recommend incorporating provincially, because when you incorporate federally, there's the perception that it is cheaper because the initial incorporation costs are a little bit lower federally than they are provincially. However, when you incorporate federally, you must register in a province, and there's a cost of registering, and you must register every single year. So if all you did was incorporate and register every single year, after about 6 or 7 years, your costs would be higher to incorporate federally than they would be provincially. In addition, if you ever get behind on your registration, your provincial registration, you will become deregistered, and the cost of re-registering is actually more expensive than the original costs of incorporation. So one of the things that we do at CA4IT is we offer what we call an at-cost incorporation for anyone that's been referred through an agency that we work with, such as Procom or any other organizations that we have relationships with. And what we'll do is make sure that we get the corporation set up and structured correctly from day one, making sure that the share structure is correct, that the minutes are correct, the shareholders agreements are there. And we'll do this at the same cost as if you were to go off and do it yourself. And this way, you know, you're getting it set up correctly from day one, not only for how you're operating today, but also how you may operate in the future. And one of the big things that we look at when we're structuring your organization is the possibility that you might set up a holding company. And when we talk about corporate structures, a holding company is a really interesting thing to bring up because typically, if you're earning money inside of a corporation and you're able to save money inside of a corporation, it doesn't take long before you've got significant assets in this entity that you want to shelter and protect. And a holding company provides an opportunity for you to segregate your assets from your operating company, which carries the risk, sorry about that, guys, which carries some risk associated with it. So you can shelter the assets from the operational risk. Plus, a little known fact about investment income, or passive income as it's called, is it's subject to a higher tax rate than the small business deduction. And one of the things that you can do when you have an operating company is you can take your salary out of the holding company instead of the operating company to bring the holding company's net income down to zero and not pay any of that tax at the higher rate. When you have everything intermingled in both an operating company and a holding company, what happens is that any deductions that you have, whether that be salary or other expenses, come off the lower taxed income first. So you end up paying tax on the higher taxed income, the passive income, first, and then the lower tax income second. So there becomes a financial advantage to having a holding company when you've got assets that are generating passive income. And it doesn't take a lot. Typically what we say is once you've got more than $200,000 worth of investable assets, it's worth having a look at whether it makes sense to have a holding company. And again, everyone's situation is different. What I recommend to any of you that are considering setting up a corporation or setting up a holding company for your corporation is make sure that you talk with a professional about your individual situation and your individual needs to find out what are the true benefits. So hopefully that answers your question.
Okay, Andrew, we have a caller that's going to call in right now.
Sure.
Hold on, so he's gonna call back. So Andrew,
Okay.
on the topic of federal versus provincial incorporation, if you're set up provincially and you go do work in another province, do you need to re-register in the second province?
Only if your mind management and control of your corporation moves provinces. So we have seen situations right now. We're seeing quite a few people moving from Alberta back to Ontario because of what's going on in the job market at the moment. So they have these Alberta corporations that we would then register here in Ontario. But you only need to do that if you're moving the mind management and control of the corporation here to a different province, i.e. moving permanently for the new job. Like if you were, based out of Ontario, taking a short-term contract in maybe the States or in another province, then you can do business in those other provinces, but still keep the mind management and control here in this province. And then you're taxed based on this province, but of course, whether you charge GST or HST is dependent on where the benefit of the service resides. And again, that's another common question that we do get for independent contractors is, should I be charging GST? Should I be charging HST? Should I be charging anything? And that's dependent on where the benefit of the service resides. So if you have an Ontario corporation, but you're doing work for a BC client, the benefit would reside in BC, so you wouldn't be charging HST. Now, if you had a U.S. client, you wouldn't be charging anything because the benefit of the service would reside in the States. So you wouldn't have to charge any GST, HST at all. And that brings up another important question as to the different methodologies that are available for you for calculating your GST or HST. And there's two options that are available. There's the quick method and the long method. And the quick method is what most of my clients are signed up for. And that's 7.8% of the first $30,000 of income, and 8.8% of everything above $30,000 is what you pay the government. The difference you get to keep. So you don't need to worry about tracking the expenses or the GST or HST on every single expense. And that's, I'm talking specifically here in Ontario, I should say, with that. It's different by the provinces depending upon their rates. But here in Ontario, 7.8 on the first 30, 8.8 on everything above that. And so the difference between 13% and that either 7.8 or 8.8 is actually profit to the company that becomes what we call sundry income. And this is a big advantage for most independent contractors, because if you look at their total expenses that they would have that would have GST on them, it would typically fall short of that. So this is a way for people to make money with their GST, HST claims. Now, if you were contracting in the States where you weren't collecting GST, HST, then the long method is actually going to be a better opportunity for you, because the way the long method is calculated is you take the GST that you've collected and you subtract the GST that you paid on various expenses. So we're talking either multiplication or subtraction. And multiplication, if you have zero income, any multiple of zero is zero. So you would pay zero, but you wouldn't get a refund. But with subtraction, if you have zero income and you subtract from that, you get a negative, which means a refund. So looking at which method is best for you is always an analysis that you should probably look at. And you can switch from the long method to the quick method, but you have to make an election to do so. And it's important to do that in a timely fashion, because once you pass certain dates, you can no longer make that election for the period. So in many situations, you know, you usually have to give yourself about a year of a leeway to make that change.
So Andrew, is this something that you can change quarterly if you're on a quarterly remittance, or is it something you change year to year, like on your fiscal year? If
you are signed up quarterly, you can change quarterly, but we would, again, for most of our clients, recommend that you're not on a quarterly method, that you're filing annually. This is going to save you a lot of work and costs associated with doing that work. So for all of our clients, we recommend that you file annually. And this is also going to change the deadlines, because when you file quarterly, your GST, HST is due 1 month after each quarter. So in addition to there being more work, you lose the time value of money because you're paying the government out much sooner. Whereas with annually, your deadline is 3 months after your year end. So it buys you a bit of extra time. Now, after your first year, if you owe more than $3,000 in GST, HST, which many people do, you will be asked to go on quarterly remittances. So you're paying quarterly, so you may not get as much benefit from the time value of money, but at least you're eliminating the need to file every quarter, which is a big headache. And if you're not doing it and the accountant is doing it for you, it's a big cost.
Okay, so you can still do remit quarterly, but still file annually.
Absolutely. And in fact, now, and what some people will do is if you miss your quarterly installments, they won't charge you a penalty, but they will charge you interest. So other people, depending upon cash flow, may have quarterly installments and elect not to make those installments. Of course, they will all be due at the end, and if you don't pay it within 3 months of your year end, there is a penalty, but you're only accruing interest from the quarterly installments.
Okay, that's great. I think one of the things that everyone's joining this call about is to really understand what are the risks that they should be looking to avoid as an independent contractor, or starting out, what should I do? And I mean, I think you started out the Blabs talking about, you know, the recommendation is to incorporate for protection purposes. But what are those things that people should really look out for as they're starting out on their business? Because, you know, we're hearing lots of things about the personal service business, which we refer to as PSB, but there's obviously a lot of risks that people are going to be experiencing with the government initiatives. So what can people do? Because I think that's really why people are joining today.
Yeah, so PSB is a big the biggest risk for independent contractors. One of the great things about being an independent contractor is you're typically profitable the day you start. So that's great. But this personal service business risk, which is the risk that you're deemed to be an employee of the end client rather than an independent contractor, can take away all the benefits that you've been accruing over time, which is, the benefits of the small business deduction, the benefits to deduct expenses. And the worst part is that they'll typically look at a multitude of years and then go back and charge interest and penalties. So if you're ever deemed to be a personal service business, it can cost thousands of dollars. One of the other things is that some people believe that if you're a sole proprietor, you eliminate this risk. But it's important for people to understand that it eliminates personal service business risk, because personal service business is something that's specific for incorporated entities. But there's still a risk that you could be deemed an employee rather than an independent contractor. So there's the whole CRA document out there of employee versus independent contractor. So just because you're a sole proprietor, it eliminates you from being deemed what they call a PSB, which is a separate type of incorporated entity that isn't eligible for the small business deduction. But you can still be deemed to be an employee and lose all of your deductions as far as expenses are concerned and as far as income splitting is concerned. So being a sole proprietor does not protect you from being deemed to be an employee rather than an independent contractor. The things that you can do to help protect you against the risk of personal service business risk or being deemed an employee is to look and act like a business. The great thing you can do is, you should have a website, you should have a social media profile, you should have business cards, you should have your incorporated entity set up and structured properly, so that if there are any risks that ever come and you're ever assessed, first of all, your income is sheltered and protected in things like we talked about earlier, like holding companies. And that's a way to protect against this. And of course, bottom line is making sure that you have a knowledgeable representative there to help you and protect you. And one of the other things I will mention is individual personal pension plans. And we do have, have some people that I think have worked with Procom in the past. They may even be on the line, who can comment more about individual pension plans and ways that can be used to shelter and protect some of the equity that you've built up. So there are ways and tools that you can do to shelter and protect income that you might have generated inside of a corporation. But the number one thing is look and act like a business, and that's how you can.
So on the PSB, I know the government's reached out to certain individuals to ask them to come in for interviews or sending them letters about PSB. What should somebody do if they're getting that kind of communication from the government? Should they seek representation prior to responding to a letter? Should they just go meet with them? I think this is something that, we, here at Procom and the APCC, and as well as CA4IT, is taking a stance on. But I don't know if everybody's aware of what to do. And, obviously when the CRA comes calling, everybody gets nervous, and people do things that may not be in their best interest for their company.
Yeah, absolutely. So first of all, you cannot not respond. That's not acceptable. But you also shouldn't be responding without having professional guidance and advice. And make sure that your representative is knowledgeable in this specific issue, because I deal with lots of accountants in my network through Intuit and through my channels on Facebook, and I deal with people who are very, very smart accountants who don't touch this field. And so they'd be great accountants on helping you get your books set up and organized and maximizing deductions. But when it comes to understanding personal service business risk, it's not something that they touch on a regular basis and wouldn't necessarily have the knowledge and the information to help protect you. And the biggest risk with PSB, PSC is you putting your foot in your mouth, because they look at a whole slew of information. There's tons of stuff on our website about the different things that they look at. Your contract, your conduct, your ownership of tools, and I know we've talked about that before in the past. And there's a whole slew of information on our website that you can find out more information about all those things that they look at. But really, what it comes down to lately is contractor conduct. Because in most situations, your contract has been put in place and has been vetted not only by the end client, but by the staffing agency. So you're usually protected with a good contract. It really comes down to conduct, and conduct is subjective. And if you answer questions in ways that seem innocent and harmless to you, like do you abide by the policies and procedures of the workplace that you of your end client, might seem like an innocent question, but actually if you said yes I do, you're actually putting yourself at extreme risk, because that's basically the answer an employee would give. And you don't abide by the policies and procedures of the workplace. You have your own policies and procedures for your corporation that happen to mirror those of your end client, because that's how you're a productive and effective independent contractor. And you can imagine, the analogy I often use is a home painter. If you hired a painter to come and paint your home, you know he has his own policies and procedures, and there's no doubt that that is an independent contractor. But he's going to have policies and procedures that make sense for his end client. He's not going to come and paint your house at midnight while you're sleeping, because you wouldn't hire him and you wouldn't recommend him. And so as an independent contractor, you have policies and procedures that mirror those of your end client. You don't follow their policies and procedures. So that's just one example. But obviously making sure that you have someone who's knowledgeable in the language and the literature around this issue is really important. So if anyone is received a letter or has gotten a call from a CRA representative, I encourage you to come and talk to us, or come and talk to many of the other professionals in the industry who are knowledgeable in this specific field.
Okay, great. So we have someone who's called in, Abdel Fayez. Abdel, why don't you go through your question? I think it has to do with moving from Quebec into the Ontario marketplace as an incorporation.
Yes, that's right.
Hi, Abdul.
Yes, hi. How are you doing?
Not too bad. Yourself?
Great, thanks. So my question is, because I was operating in Quebec, okay, from 2011, okay, and my question is, I would like to register, under Ontario, but it's, to me, it's like a little bit confusing, should I close the company, the corporation in Quebec, then register in Ontario, or can I transfer my? Can
you register your corporation here in Ontario? Yes, you can. Now, Quebec is unfortunately almost like dealing with a different country when it comes to tax. So it is Revenue Quebec is very different than dealing with Revenue Canada and CRA. So while it is possible, it might actually be easier, depending upon your individual situation, to close down the corporation and set up a new company. It would depend on where your retained earnings are. If you've got a lot of retained earnings, it's probably going to worth the extra steps and the headache of registering in the province than it is to close down the corporation. Because if you have a corporate entity and it's got retained earnings, in order to close down that corporation, all of those retained earnings need to be drawn out, and that could be a big tax liability for you depending upon what the retained earnings are. The other option could be that you set up a brand new corporation and you wind down that other corporation slowly over time. But again, there you've got this issue of now you've got to maintain the sets of two books, and there's additional accounting costs. So you really have to look at your individual situation to see what the cost benefit is. Certainly it's nice and clean to set up a new corporation, and particularly with us, that would probably be cheaper for you than actually taking your existing Quebec corporation and registering it here in Ontario. But we have to look at the bigger picture beyond that, and that comes back to your individual situation and what type of retained earnings you have in your corporation. Does that answer your question for you?
Yeah, I think I got it. Well, I think I will start to register under Ontario, okay, and step by step I will close the one under Quebec.
Yeah, and again, what I would recommend is come in, talk to. You can book a free consultation with us. There's no charge for an initial consultation, and we can have a look at what makes the most sense, because we're talking high level here, and obviously you're not going to disclose your financial situation in a live blab here. But knowing and understanding the numbers will help me to be able to give you a better structure and plan for how we move forward.
Great. I think what Andrew's also getting across is that every situation is probably a little bit unique to every individual. And so, you know, Andrew's answering questions at a large here, but there's obviously individual unique situations that you need to talk to an expert about in order to ensure that you're setting up your company that works the way that your business operates. So whether it operates in multiple provinces, multiple countries, it's probably best to seek expert advice on that.
Yeah, you should always speak to a professional about your individual situations, because anything that you find online, anything you hear in a pre-recorded blab is talking high level and may have differences for your individual situation.
So Andrew, obviously there's lots of tax benefits when you're incorporated. Is there like specific things that people should know? I mean, you've touched on that, the home office, you've touched on the car. Is there anything else that people, you know, obviously here within Procom, we see people that are temporary employees, there's sole proprietors, there's incorporations, and, you know, obviously when you're new to moving from that permanent employee structure into the role of a contractor, no matter what status it is, there's obviously benefits. You know, what other benefits outside of the home office and the car would you highlight to these individuals?
Well, the first thing I would say is that there's really no limit to the types of things that you can deduct. The guidelines that CRA says is, first of all, it can't be disallowed by the Income Tax Act. There's not that many things that are specifically disallowed by the Income Tax Act, but there are a few things. Most notable are golf green fees, club memberships, life insurance, and your home telephone line. Outside of those things that are specifically disallowed, the guidelines basically say any expense that was, one, reasonable, and two, spent with the intent of helping your business earn income sometime in the future. Now, that is vague and open to interpretation. Reasonable in and of itself is a subjective term, and understanding whether the expense is going to help your business earn income sometime in the future is also very subjective. And CRA is going to have a point of view, which is typically the most conservative point of view. And what we try to help our clients understand is that they can take a more aggressive standpoint, and we want to encourage them to look at all of their expenses that they're spending and try and find a business reason for why that's going to help them earn income in the future, and to approach these things as aggressively as possible. And you're never going to be thrown in jail for taking an aggressive interpretation of business expense, because it's just that, it's an interpretation. And like I said, it's not defined by the Income Tax Act, so it's not black and white. It comes down to interpretations of case law and various cases that have gone before the courts in the past. And what a lot of people don't realize is it's not what CRA says that matters. It's not what your accountant says that matters. Unfortunately, it's not even what you say that matters. In the end, it's what a judge says. So hopefully you never get to that situation where you're in front of a judge, because there are 3 levels of appeals within CRA. So you have the ability to sort of argue the merits of your case up to 3 levels of appeals within CRA. And typically, as you move through those levels of appeals, you get more and more reasonable auditors who have experienced more a wider variety of cases and who are more open to the different things that a business might incur as far as deductible expenses. And typically at the lower levels, where you're getting the most junior auditors, they're taught that if they don't know what to do with an expense, to disallow it. And so the number one tip I would say is, if you're ever reassessed and disallowed an expense, to recognize that that's not the end, and that you need to continue to argue the merits of your case. And I'll give an example of another category I'll give a couple of examples of categories that people often miss out on or aren't aware that they can deduct. So the first is a fairly small one, but does add up over time, is books and periodicals. So anything that you're reading, even if it's not specific to, like, say, project management or a specific set of coding that you're doing, anything that you're reading at all is part of the body of knowledge that you bring to the job that you're doing, and is therefore, as far as we're concerned, deductible. So all newspapers, magazines, online subscriptions, books and periodicals, Audible, all of that is going to be legitimately deductible. There's other categories where we get much bigger deduction, things like what we call business promotion or meals and entertainment. Typically, when people come from a full-time role, they assume that if I'm having a meal with a friend or a family member, that it can't possibly be deductible. This is a friend of mine, this is my family member, it's not deductible. But we believe that the people who are actually most likely to recommend you, to provide guidance for your business, to help you grow and succeed as a small business owner are your closest family and friends. And therefore, the time that you're spending with these people are likely to help your business grow and succeed and are therefore deductible. So now you've got these meals and entertainment that are deductible, plus all the auto mileage of driving to these meals and entertainment and social gatherings. So that's a deduction that is often overlooked. We also have sort of different ways of looking at your home office expense. So typically, home office and automobile are what we call percentage of use calculations. You're not taking 100% of the deduction, you're taking a deduction as it relates to your business use of that. And how you calculate the business use can make a substantial difference in your deduction. Again, looking at the automobile expense, if you're not including any of the mileage to go to any of those meals or entertainment that you thought were family related or personal, can make a big difference in your total deductions as far as the business promotion, but also in your automobile expense. Another example would be your home office and how you calculate the expenses related to that. And there's a couple methodologies that you can use. You can use the number of rooms, which is probably in most people's situation, the least effective, or you can use square footage. And square footage is typically what we'd use, but when we're calculating square footage, we look at the whole home, including the garage, which is used to store the business vehicle, as well as typically files and storage and other things like that. So we include that in the calculation, but we subtract out what we call the common areas, which are kitchens, hallways, and bathrooms. And by making that subtle distinction, we can actually typically change the deduction from maybe 10 or 15% to 20 or 25%, which when you think about what you're deducting in your home office, which are utilities, property tax, mortgage interest, that adds up to a significant difference in your bottom line. And sorry, go ahead, Wendy.
So Andrew, on that, if I've previously been using as an incorporation or as my business the 1 out of 9 rooms, can I switch to a different method in the upcoming tax year?
Yes.
Without raising any flags?
Yep, absolutely you can, because the calculation method is not actually something that's disclosed to CRA. They just get a number. And the other thing to keep in mind is that typically your home office, which goes under the rent expense, is far below what most other businesses are paying in rent. So it sort of flies under the radar in most situations. The same with things like advertising and gifts that you might be doing under advertising expense, which is another category. In advertising, once upon a time, you used to be able to deduct business clothing. CRA has been really closing the door on that lately, which is a shame because I still think personal grooming and professional attire is still a very important part of business. And while there's nothing in the Income Tax Act that specifically disallows it, there have been a couple of court cases that have been fought and won by CRA fairly recently. The most notable was a lawyer who had been claiming his business suits, which for us, for years, business suits have been a slam dunk win. But unfortunately, the expression around here was pigs get fat, but hogs get slaughtered. And he'd been fairly aggressive in his deductions with very expensive suits, and many of them. And the judge basically said that anything that he believed that anything that you could wear out on the streets for public use that contained dual purposes could not be deducted. And that's something that CRA has used as a reason to deduct business clothing for most independent contractors. Now, because it's not specifically disallowed in the Income Tax Act, we would let clients to make that deduction, making sure that they're aware that there's a high risk that if CRA does assess, they could disallow this deduction. But in many situations, because advertising is well below what typical people spend in advertising, it again sort of floats under the radar. So it's certainly a very aggressive approach that has been fought and lost in a couple court cases now, and would most likely be disallowed by CRA. You still have an argument, so you're not committing fraud, you're taking a very aggressive interpretation. So that's an example of sort of gray area expenses where A good accountant can help you identify areas of risk and areas of opportunity.
So just on a simple level, things that maybe just a common contractor would have that they may not be deducting at this point would be, from a social media perspective, an upgraded LinkedIn account,
yep,
or a Hootsuite account where they're managing their engagement content. Those types of things, although they're not a ton of money, you know, an upgraded LinkedIn account could run you $1,200 a year or something like that. That would be an allowable expense.
Absolutely, and hosting for your website and cost for doing business cards, all of that is going to be legitimately deductible as well. And there's also other things like one of the common things that often gets overlooked is home office expenses, on office supplies, things like garbage bags, light bulbs, which are often encompassed in a grocery bill and often overlooked, but over the course of time add up to several $100s. So they're little small things that people often miss out on as deductions that they're truly eligible to deduct.
Okay, great. We had one question from Krista that came in a while ago, but we didn't get back to it. It says, other than tax deductions, as a contractor, I can find that this will make a difference in terms of the hourly pay rate. As a contractor, would you recommend incorporating, considering contractors do not receive corporate benefits?
So as far as employee versus independent contractor, whether you're sole proprietor or incorporated entity, you're typically going to take home a lot more money than being an employee. A lot of the reasons that people go to full-time employment over independent contracting is for the false sense of security. People believe that they have, you know, with employment insurance and with severance pay, that they've got some benefits and some security in being a full-time employee. I can tell you that for people who are talented and are good at what they do, that's just probably not the case. First of all, if you are good at what you'll do, you're probably never going to make use of EI or severance. So you're basically, this is a benefit that you'll never actually receive. And people who are in demand, and you know, Wendy and the people at Procom can speak better to this, there is a constant shortage for top talent.
Man,
so if you're good at what,
I feel like once he said, like, we've been knowing each other since 4, and it was like we were supposed to be married.
Okay, that was interesting. But so yeah, I would say that as far as the financial benefits of employment versus independent contracting, first of all, as an independent contractor, you're going to be paid more because the end client doesn't have to pay for these benefits, which is what allows them to give you a higher hourly rate versus the salary that you would receive. And you self-insuring for things like benefits is usually typically cheaper than the benefit package that you would get. Plus, in many situations, if you're married and you have a spouse who is a full-time employee, you're typically covered by insurance and benefit plans through them. So again, you'd be the end client would have a cost that you're really receiving not much of a benefit for. So that's a big advantage. And then when you talk tax, that's where you're getting a massive benefit, because as an employee, everything that you're earning is being taxed at the marginal tax rate, which, as we talked about, can go as high as 46%, versus the ability to deduct expenses. And any expense that you deduct, you pay zero tax on. So whether you're a sole proprietor or an incorporated entity, if you've got $10,000 worth of deductible expenses, that's $10,000 of income you're getting tax-free. And typically, if you're an employee, you're still going to have a home, you're still going to have a cell phone, you're still going to have internet access, you're still going to be spending money networking and building your relationships, because let's face it, even as an employee, your job is not secure unless you're good at what you do and you have a good relationship and a good network.
Okay, that's great. And now, just on that topic, is there a dollar number, like an hourly figure, where you would say it's, you know, below this level, it doesn't make sense to incorporate? Like, is there a magic number out there that people should be considering?
This is a difficult question. I get asked this frequently, and lots of caveats I'm throwing out here, but generally speaking, around $30 an hour. If you're under that, you're probably not going to get a financial benefit of being incorporated, because a lot of the financial benefits come from the ability to leave money inside of a corporation. And if you're under $30 a year or $60,000 a year, you're probably not going to have a lot of money left over at the end of the day for savings. So you may not get as much of a financial benefit. But again, everyone's situation is different. And imagine if you're earning $30 an hour, but you have a high income spouse, and you're able to use that spouse's income for the majority of your non-deductible expenses, then you would actually have the ability to leave money inside the corporation. Even though you're not earning a large income, that income is disposable income and it can be saved and retained inside the corporation, allowing you again to make use of that small business deduction. So big caveat, everyone's situation is different, and don't just use an hourly rate, talk to a professional to seek guidance. But generally speaking, if you don't have money left over at the end of the day for savings, the corporation isn't going to provide you a large financial advantage.
Okay, that sounds great. Well, I think we had this scheduled for 30 minutes. We're already at over that time period. But Andrew, I want to thank you for taking your time. Obviously, you're definitely an expert in this field, and I know that a lot of the consultants from Procom and everyone else who's joined has appreciated the insight you've provided. We're going to be back at the beginning of next month. I think we're looking probably Monday, April 3rd. To do our next one, and I think we're looking at doing it more of an in-depth look at tax deductions as we head into tax season for those who have a April 30th filing date, and for others, just to help prepare yourself for the upcoming year.
Excellent. Looking forward to it.
Great. Well, thank you so much for your time, and thank you for everyone from joining from this for our first Blab, and we'll definitely be able to share some more of this content out.
Excellent. Thanks, everybody.
All right. Thanks, everybody.
Bye for now.
Bye-bye.